A credit score is a statistical number that evaluates a consumer's creditworthiness based on their credit history. Lenders, such as banks, use credit scores to determine who has higher probability of repaying a loan at what interest rate and for what credit limits. Lenders also use credit scores to determine which customers are likely to bring in the most revenue. After calculating a customer's credit score through a series of parameters, lenders can set a cutoff value. Credit is granted to those applicants with total scores over this cutoff value and denied to those with a lower score below the cutoff value. But how is this cutoff determined? Generally, lenders take into account three different parameters. First, the estimation of the probability of default. Second, the risk that they are willing to assume. And finally, laws and regulations concerning lending activity. Selecting a cutoff involves determining the optimum balance between approval and loss rates. Lenders must evaluate how much additional revenue will be added if the approval rate is increased and what the cost associated with the incremental increase in the bad rate will be.
Overrides, which are exceptions to a bank's normal credit scoring parameters or when a bank overturns a decision from a model. There are two types of overrides. A high-side override are decisions to deny an applicant whose credit score exceeds the cutoff score. Alternatively, a low-side override are decisions to approve an applicant whose credit score falls below the cutoff score. The reasons for these overrides can be either discretionary or based on some type of compensating factor. Discretionary overrides are staff member decisions to overturn a system or model decision. There may not be any quantifiable attributes documented for these overrides. Instead, they tend to be subjective and can be based only on gut feelings, leading to inconsistencies and greater risk for the bank. Financial institutions should therefore avoid discretionary overrides as much as possible and strive for all overrides to be based on compensating factors. Overrides based on compensating factors tend to be less subjective and are generally quantifiable. These take into account new information not factored into the bank's credit scoring model. For example, let's say our combined model in Chapter 2 classifies an applicant named Sally as good risk. According to policy, she would be approved, but a bank employee made a decision to deny her application because it discovered that Sally's company was about to go out of business. This is an example of a compensating factor being used for a high-side override. However, even though there may be good reasons for overrides, a high volume of overrides negates the benefits of an automated scoring model and can make it more challenging to properly evaluate and refine scoring criteria. Balancing discretionary and compensating overrides should be combined with a strong credit scoring policy in order to reduce risks and increase profitability.